We have heard many analysts call the current financial crisis as systemic. How would you describe this?
I think it's definitely systemic. I think there's no question about it. I mean, what we've basically seen is the Fed lower interest rates right down to zero virtually, and then increase them quite abruptly and very, very quickly. There are going to be some things that break in the process, and the things that break in the process are going to be those kinds of firms that are most exposed to interest rates, and that's the banks. And when you get that kind of sort of whipsaw lashing back and forth in terms of interest rates, there's going to be some breakage, and that's what we're seeing. And I don't think it's going to be limited to sort of these regional banks or these smaller regional banks. We're starting to see some stress and strain sort of the super regionals as well. And even some of the larger bank stocks are under a tremendous amount of pressure today. So this is a systemic problem. The systemic problem is this very abrupt change in interest rates that Jay Powell has engineered, first of all going very, very low during COVID and then suddenly going very, very high. That's going to lead to some problems, and that's the stresses and strains we're seeing right now in the market.
Given Bill Ackman's earlier advice, the possibility of government intervention, and the fact that even stable banks may experience significant drops, some investors may wonder if they should buy regional bank stocks on dips. What would your recommendation be to investors?
Well, if you're buying in the dips in the regional banking stocks, I think you need to have a look at the balance sheets and where they stand. And they're slightly difficult to read from the perspective that they do not mark their losses to market. And so you can't really make out what kind of financial situation a bank stock is in very easily by reading its financials. So you have to read between the lines, you have to read the footnotes, and that makes it very difficult indeed. And that's what we've seen in this crisis, is basically the banks have these big losses on their loan portfolios, on their securities holdings, and those aren't reflected really in the balance sheets. And so it's only once they start to try and sell those assets that they really sort of come to fruition, and you start to see those losses being crystallized. And that is where the problem lies. So you can't really see it, and it's very hard to judge it. Now, 40-50% loss sounds huge, but we've seen 100% losses. We've seen a few big banks basically disappear and the shareholders being wiped out. That was the case at Silicon Valley, that's at First Republic, Signature Bank. We've seen a lot of 100% losses, and that's, I think, what we're looking at some of these other regional banks. I mean, I don't see how PacWest survives today. They're down about 60% today. I don't think banks survive that kind of fall in stock price. I think they're going to be wiped out very, very soon.
According to Octavio, the Federal Reserve's abrupt change in interest rates has led to stress and strain on regional banks in the US. This has resulted in some firms, especially those most exposed to industries, being at risk of breaking. Even larger bank stocks are also under pressure due to this issue. He notes that it is difficult to read regional banks' balance sheets and understand their financial situation, as they do not mark their losses to market. This makes it challenging to assess their risk accurately and judge their true financial standing. Therefore, investors need to carefully examine the financials of regional banks before buying their stocks. Looking at Pacific West, a specific regional bank whose sharp fall in stock price may make it unable to survive the current crisis, he suggests that similar banks may face similar challenges, leading to their potential collapse and shareholder wipeouts. Investors should be cautious while investing in regional banks during this period of stress and strain.